Yo, what's good, future traders? It's your boy, Mr. Flip, back for Chapter 2 of our trading adventure. Welcome back. If you crushed Chapter 1, you already know what trading is, how markets work, and why you gotta keep your cool. If you missed it, no sweat. Go check it out, then slide back here. This time, we're leveling up. Think of Chapter 1 as learning to ride a bike with training wheels. Now we're popping those wheels off and hitting the streets. We're diving into practical stuff, how to read charts, manage your risks like a pro, and even pick your first trades. By the end, you'll be ready to open a demo account and test the waters. Sound dope? Let's roll. First, let's recap. In Chapter 1, we talked about trading basics, buying low, selling high, and not freaking out when the market gets wild. You learned about stocks, forex, and crypto, plus why patience is your best friend. Now we're building on that. We'll learn tools like candlestick charts, simple strategies, and how to not blow your account on a bad day. You ready to get serious? And like always, I want to hear from you. Drop in the comments. What's one thing you learned from Chapter 1 that blew your mind? Let's get this convo poppin'. Alright traders, let's talk charts. If trading's a game, charts are your map. They show you where the price has been and give clues about where it's going. Today we're learning candlestick charts, the OG tool for traders. Ready? Let's dive in. Imagine you're looking at Apple's stock price. A candlestick chart shows the price action in chunks of time, like a day, an hour, or even a minute. Each candlestick is like a little story. It's got a body showing the opening and closing price, and wicks, which show the high and low. Green candle, price went up. Red candle, price tanked. Simple, right? Here's a real example. Say Apple's daily chart shows a big green candle. That means buyers were hyped, pushing the price up. But if you see a tiny candle with long wicks, it's like the market was confused. Buyers and sellers duking it out. Cool, huh? Now let's talk support and resistance. Support's like a floor. Price hits it and bounces up. Resistance is the ceiling. Price struggles to break through. Picture Tesla's stock at $300. If it keeps bouncing off $280, that's support. If it can't break $320, that's resistance. Spot these levels and you're halfway to predicting price moves. Try this. Pull up a chart of Amazon or EUR/USD on a free site like TradingView. Look for a support level where the price keeps touching and bouncing. Found one? Drop it in the comments. Let's see who's got the sharpest eyes. Yo, real talk, trading's not just about making bank, it's about not losing your shirt. That's where risk management comes in. Last chapter, we talked stop loss basics. Now we're going pro with position sizing and risk reward ratios. Buckle up. First, position sizing. This is how much money you put in a trade. Rule number 1, never risk more than 1 to 2% of your account on one trade. Got $1,000, that's $10 to $20 max risk per trade. Say you're trading gold and your stop loss is $5 away. Divide your risk, $20, by the stop loss, $5, and boom, you trade 4 units. Easy math, big protection. Next, risk-reward ratio. This is how much you could win versus what you're risking. Aim for at least 1 to 2, risk $10 to make 20. Example, you buy Starbucks stock at $100, stop loss at 98, and target 104. That's $2 risk for $4 reward, a 1 to 2 ratio. Stick to trades like this and you'll stay in the game. Pro tip, keep a trading journal. Write down every trade, why you entered, your stop loss, and what happened. It's like a cheat code for learning. Wanna flex? Tell me in the comments, what's one risk management trick you're gonna try? Let's hear it. Time to get tactical, traders. Today we're building your first trading strategy, the moving average crossover. It's simple, beginner-friendly, and works on stocks, forex, even crypto. Let's break it down. A moving average smooths out price data to show the trend. Think of it like the average price over, say, 50 days. We'll use two, a fast one, 10-day, and a slow one, 50-day. When the fast MA crosses above the slow MA, it's a buy signal. Price is trending up. When it crosses below, it's a sell signal. Trend's turning down. Example, say you're trading USD/JPY. The 10-day MA crosses above the 50-day MA. You buy, set a stop loss below recent support, and aim for a 1 to 2 reward. If the trend keeps going, you're golden. But don't just follow blindly. Check the chart for support or resistance nearby. Test it on a demo account first. Pull up SPI, an ETF, or Bitcoin on TradingView, add the 10-day and 50-day MAs, and spot a crossover. See one? Screenshot it and share in the comments. Let's compare notes. Alright, you've got the skills. Now you need the tools. Let's talk trading platforms. These are the apps or software where you'll make your trades. Think Robinhood, MetaTrader, or Thinkorswim. How do you pick? Let's figure it out. Robinhood is great for beginners. It's mobile-friendly, commission-free, and perfect for stocks like Apple or ETFs. Downside, limited tools for advanced analysis. MetaTrader 4 is a beast for forex and crypto. It's got tons of charts and indicators, but the interface can feel clunky at first. What to look for? So, a platform with a demo account, low fees, and assets you want to trade, stocks, forex, etc. Also, check if it's regulated, safety first. My advice, start with a demo on Robinhood or MetaTrader. Place a few fake trades to get the vibe. Your turn, Google one platform like Interactive Brokers or eToro and check if it has a demo mode. Found one you like? Drop the name in the comments. Let's see what you got. Trading's not just charts and numbers, it's a mental game. In Chapter 1, we talked about staying calm. Now, let's go deeper into trading psychology. How do you handle losses or resist jumping into a hype train? Let's find out. First, losses will happen. Even pros lose trades. The key? Don't take it personal. A loss doesn't mean you're bad, it means the market's doing its thing. Example, you buy Tesla at $350, it drops to $340, and your stop loss kicks in. You lose $10. Shrug it off, log it in your journal, and move on. Then there's FOMO, fear of missing out. Say Dogecoin's spiking because Elon tweeted. Everyone's buying, but you don't have a plan. Don't chase. Stick to your strategy. Deep breaths, homie. Your challenge. Next time you feel stressed about a trade, take 5 deep breaths before acting. How do you stay chill under pressure? Tell me in the comments. It's go time, traders. Today, you're placing your first demo trade. No real money, just practice. We'll use the moving average strategy from earlier and walk through it step by step. You got this. Step 1, pick a platform. Let's say Robinhood Demo Mode. Open it and find SPY and ETF. Step 2, check the chart. Add 10-day and 50-day moving averages. See a crossover? That's your signal. Step 3, set your stop loss. Say 1% below entry and target 2% above for 1-to-2 ratio. Step 4, place the trade. Enter $1,000, fake money, hit buy, and confirm. Step 5, watch it play out. Did it hit your target or stop? Log it in your journal. Try it this week. Open a demo account, place one trade, and track it. How'd it go? Share your first trade story in the comments. I'm hyped to hear it. Nobody's perfect, especially not rookie traders. Let's talk common mistakes and how to dodge them. Think of this as your cheat sheet to not crash and burn. Mistake number 1, trading without a plan. Jumping into trades because it feels right is a recipe for disaster. Fix, always have a strategy like our moving average crossover. Mistake number 2, risking too much. Betting your whole account on one trade? Nope. Stick to 1-2% risk. Mistake number 3, chasing trends. Saw GameStop mooning on Reddit? Don't just buy because everyone else is. Wait for a setup. Pro tip, if you miss a trade, there's always another bus coming. Your homework, write down one trading mistake you've made or think you might. How will you avoid it? Drop it in the comments. Let's learn from each other. And that's a wrap, traders. You just crushed Chapter 2. Let's do a quick rewind. You learned how to read candlestick charts, spot support and resistance, and manage risk like a boss. You got a simple strategy, moving average crossover, and even placed a demo trade. Plus, you know how to pick a platform and keep your head in the game. Yo, that's huge. Trading's a journey, not a sprint. You're not gonna be Warren Buffett tomorrow, but you're building the skills to get there. Keep practicing, stay disciplined, and don't let losses shake you. Every pro started where you are now. Here's your big challenge. This week, open a demo account on Robinhood or MetaTrader. Place one trade using the moving average strategy. Set a stop loss, aim for a 1-to-2 reward, and log it in your journal. Then come back and tell me how it went in the comments. I'm rooting for you. Stay tuned for Chapter 3, where we'll dive into advanced strategies and maybe even some crypto chaos. Until then, keep learning, keep trading, and keep being awesome. Mr. Flip, out.